Hello everyone, my name is Kamal Manocha. I represent PMSAF World. We have been doing Friday webinars, and every time when we do webinar with some new fund manager, I am always most excited because that's the time when one can learn more from new fund manager, someone who has been trying to do new work in this very competitive industry. Obviously, comes with something innovative, something different, and hence with open mind I equally keenly listen to all new fund managers. Welcome Shivaji to this webinar. Before we begin, I'll maybe spend 2 minutes in introducing Shivaji to you. Shivaji has been kind of bringing with him more than 20 years of experience, pertinent and relevant experience. He has good following because he's a mentor and kind of provides training to students as well. He's a kind of, you can say, a professor turned fund manager who understands the subject and does it with a lot of passion. And he's trying to actually, I think, do good work in the long short space, which till date in India I have not seen any fund manager actually really doing good. All fund managers and many fund managers actually have come and kind of tried to promise a lot, but results have been relatively low because of many factors which I am aware of, which I do not know if Shivaji is aware of not, because he's a new fund manager. Because every fund manager has to go through learning, but we will cover that in the subsequent part of this webinar when I'll ask questions and answers. But before that, let's hear it out from Shivaji for whatever presentation he has. Over to you, Shivaji. From here onwards, first 30 minutes you spend on presentation, and then we'll do Q&A.
Okay, thank you so much. Good evening all. I'm grateful to Kamalji for giving this platform and opportunity to speak to a lot of excited people over here. And I see in 193 count, and it's still going up. I hope we will have large audience today. Great. So today I'll talk about a lot of multi-asset, from global markets to commodities to currencies to Indian markets. Right. So as a new fund, how do we approach market globally, locally, before we make any sort of investments? What is our strategy? So I'll give a brief presentation. Of course, I have a lot of slides to show, and I request your patience as well. So here we go. A quick introduction. I basically come from an engineering background. I did my engineering in electronics and communication from Bangalore. I worked in India for 10 years, and I moved to Germany in 2017. So this is my professional background, but we recently started up with two products, and I launched two companies, Samarth Equities Portfolio Managers, as well as Shine Wealth Management, which is a gift city based company. If you are tracking me on Twitter from last 4 or 5 years, so PSU, PSE, Realty Auto, this has been my top picks in the last couple of years. And I came up with a silver bat last year in 2024 and platinum in 2025. So we come up with new things every time. Why new things every time? We will talk about it in next slides. So that will give you a lot of insights as well. So just to give you a brief background, I was a test manager in Valeo Siemens Automotive Germany until 2024 for e-car, that is electric automotive. And before that, I worked in India for Ministry of Defense, Honeywell, HCL Tech, and Robert Bosch. So I worked for a very large client base, including commercial as well as fighter aircrafts, and also in the automotive industry for large OEMs like Audi, BMW, Mercedes, and Volkswagen as well. So these are some of the products we developed, and I worked as a test manager. I also worked for the Boeing 787 Dreamliner 78. Recent we had a crash, right, on the flight control system. So I understand the system much better. Yeah, of course, we also worked on A350. I also worked for LCA Tejas and some of the private or corporate jets, you can say. And I also have good experience in the automotive industry. So this has been my professional background for last 17 years. So I come from a very different background, to be very frank. So this is where I live, which is Germany, south part of the Germany, a city called Erlangen, a beautiful city. This is where we run our two funds from. So everybody is thinking, why is he running funds from Germany? So the thing is, it gives an added advantage of time zone. So we can manage a lot of global markets as well as Indian markets. So this is one biggest reason. Well, talking about our two funds. So recently, in 2025, we launched our two funds. Both are operational. One is in Gift City, which is Samarth Invest India, which offers 0% tax on derivatives, which is 4 months old. We come up with a Samarth Emerging Fund for Indian retail, which is for the domestic Indian residents, which is 1 month old. We started last month itself. So these are quite new products, and we will talk about the next product which we will come up. That is the Samarth Global Fund, which will be based out in Dubai. So we will be investing in global indices, global stocks, commodities, in COMEX, you can put it that way, currencies, wherever we see opportunities. So who can participate? So we are opening up this product for both Indian resident as well as NRI, OCL, and foreign nationals. So Indians can come via the LRS scheme. You're allowed to invest up to 250,000 US dollars. Well, this is our investment approach. So we basically focused on reliable returns. We look at market volatility. We look for alpha when there is instability in the market as well. Of course, bull markets are pretty easy to make returns, but we are looking at making a far better return even when things are not good. So we will discuss our performance in recent times as well. So basically what we do is we mix both fundamentals as well as technicals. So technical is used to time the market. Of course, we back it up our picks with the fundamental as well. So we have an investment committee of 8 members, of which 5 are technical analysts and 3 are fundamental analysts. So any entry or exit is typically based on the technical, because that gives you the timing. So in stock market, most important thing is the timing. So that we decide based on technical itself. Of course, we deal with a lot of liquid names, a lot of stocks which are highly traded and widely held. So it gives an opportunity for us to liquidate the entire portfolio in a pretty quick time as well. And we are more of a sector agnostic fund. We invest in 5 to 7 sectors, and as you see, every year there are a lot of sectors changing with the leadership. So in the same year, we do not have the same sector performing consecutively for 2 years. So every year we see the sectors are changing, hence our picks are also changing. So markets are dynamic, we need to change our investment time frame as well. So we do not deal in the unlisted space. We don't deal with IPO, pre-IPOs or SMEs. Rather, we deal in the listed space, and we look at 3 to 12 months of time frame as well. Because if you see any trend, it doesn't go up beyond. So basically we look at a lot of criterias in order to take a bet. If you are looking at 3 months or 12 months kind of investments, as I spoke a couple of minutes back, so we look at a multi-year breakouts or a multi-top or a multi-month breakouts that can give you a minimum of 20-25% kind of moves. Sometimes becomes multi-bagger in case of, if you see 2023 kind of moves. So these are our large bets in terms of our allocation. We also look at bottom reversals after a big fall, which could be in the accumulation phase. Recently we had a big fall in the market in Jan and Feb, and we got a lot of bottom reversals as well. We also look at underperformances in any sectors, and if there is any possibility of a fundamental turnaround or a technical turnaround. So typically it can be 2 to 5 years, or it can go up to decades or a multi-decade also. Okay, so we deal with highly liquid and widely held sectors or a stock. We usually avoid micro caps or small caps. As I said, we don't get into unlisted space as well. So we deal with a lot of quality mid caps with 40,000 crores or under 100,000 market cap. Okay. We focus majorly on large caps, mega caps, sector indices like Nifty, Bank Nifty, or a junior or a mid cap index or a Nifty finance. You can name them. And we also deal with commodities and currencies as well. So since we avoid a lot of small caps and mid caps, so we usually go for the indices where there is less beta, less volatility, and that gives an edge for us to get into those spaces and make some kind of gains as well. So this remains our core principle in investing, or in taking a very short-term bet as well, depending on the market dynamics. Well, how do we manage the risk part? This is a big concern for many investors or new investors in our fund as well. So basically, we go for deleverage. We raise the cash straight away. So we are not a long only fund. We are actually a long short fund. So we are not mandated to keep the stock longer in the longer run. So we can go up to 100%, cash. That is allowed. And we can also go short on sectoral indices, including the benchmark, which is Nifty. We can short Bank Nifty, Nifty Finance, IT, Nifty Junior as well if there are cash stocks. So because cash stocks you cannot hedge with our futures, or you cannot buy a put option if you want to hedge them. So best option is looking at the beta factor of the stocks. You can go short on these things. And then there is a combination of long short based on sectors and stock. We can keep the ratio from 80-20 to 50-50 as well, depending on the market direction or the dynamics. We can also go for naked short or options to hedge the liquid names. And one of the best approach is the stop loss on trend change. So we exit whenever there is a complete trend change. We believe the story is over, or the move is done, or something bad has happened suddenly. So in those cases, we make sure the risk management is taken care. Then with respect to Samarth Invest India and Gift City Fund, so 1.3 crore equivalent, USD 150,000 is the minimum capital required. So 1 year is the lock-in. There is exit load, so you can read. Maybe we can share later on. Since we have lost enough time, so I would not spend much time. So there is a hurdle rate of 10%, performance fees of 20%, management fees of 1.5%, admin fees of 0.5%, and one-time set of fees of 0.5% as well. So this remains same even for the domestic fund as well. So there is no change except the fact that the ticket size is 1 crore and there is a tax component. So one biggest difference between the AIFs and the other products is we pay taxes at the fund level. So the investors, what they get is the tax paid return. So they don't have to pay taxes again on that. So that is one biggest headache we are taking off from the investors. So we typically have 20-25 stocks in a bull market, sometimes can go up to 28 also if the the sectors, or there are a lot of opportunities available in the market. Now, who are our service partners? The trustee is Orbis, the custodian and the broker is Nuvama, transacting platform is State Bank of India. Legal aspects are taken care by ICU, Universal Legal Mumbai, RTA and digital onboarding, Dovetail for Gift City, K Fintech for domestic. So we have two tax consultants, BDO and Bhutta Shah, for direct and indirect taxes as well. So now let us look at our performances. The first fund we launched was Samarth Invest India, which is category 3 AIF. So as on 30th June, this is our performance. So we are currently $6 million and $2 million is in pipeline. So we will end up $8 million by the end of this month or probably next. And then you see the performances. We are up 46.62% net post-tax, post-expenses in the last 4 months. So $100 invested in Samarth Invest India as of today has become $146.62. That is the kind of growth we have seen using the long short fund. And we have seen a lot of volatility due to Trump tariffs. There was India-Pakistan war, there was Israel-Iran conflict. Despite all that and all those challenges, we are able to produce one of the magnificent performance in the last 4 months in the Gift City. And coming to the monthly performance, you can see March, April, May, even the June. So we have back-to-back three double-digit growths in the month of April, May, and June. We started off under 5% in the March against the Nifty 6%. So if you look at the whole gains, Nifty is up 14.5% and we are up 46.62% net. This is our net asset value as of today. Coming to the Samarth Emerging Fund performance, which is pretty new, as I said, we started last month. The ticket size is 1 crore. Currently, we stand at 62 plus crore with a 20 crore in pipeline. So we would be somewhere around 80-85 by the end of this month. So 107.92 was the gross, 103 is the net. There is a typo here. 104.45 is the net performance. So this is our performance compared to the benchmark. We still beat all the benchmarks on the gross level with a 7.92% as well. So now the interesting topic. Of course, we did all these performances. What is our approach? How do we look at the current scenario? Of course, when you look at investing at the current situation, we look at what is happening globally as well, what Trump might come up, what can happen in China, what can happen in Europe. So a lot of concerns are there with the investors. So what we believe is we look at selection, allocation, and rotation. So we look at global markets from a different perspective, and we believe there is always a bull market somewhere. So we try to find out, figure out an opportunity, because it is possible that there could be, you might be experiencing downturn in some markets, and some markets can be experiencing growth. For example, if you see January and February 2025, India was going down, whereas Europe was picking up. So if you have a global fund or a global allocation, how do we approach it, and where India is placed right now with respect to emerging market? Do we have one of the best opportunities right now, or do we have to wait? Let's see some of the charts. So I'll just quickly run through the charts as well. So I will take you to the history right now, just to give you a perception that how some of the markets could be underperforming and some markets can outperform in the same duration. So this is Nifty versus Dow Jones in 1996 and 2004. You see that our market did not perform well, whereas Dow Jones did well. So this is a ratio chart. I'll show you the price chart as well in the next slide. Look at here. 1996 until 2004, barring this one spike in 2000, Nifty literally did nothing, or Sensex literally did nothing. Whereas you see here, there is a huge move in the Dow Jones. Dow Jones was up 250%, whereas Nifty barely moved anywhere in this time frame as well. So that means somebody had an allocation to United States would have made far better return compared to India. That means how you need to rotate your allocation is very key here. Now coming back, what happened in 2005, we actually broke out after 10 years of underperformance. We outperformed Dow Jones in terms of ratio chart. Let me move to price chart, how we did it. Look at here. Dow Jones did not move anything at all. So it was barely up 10% in 2004 to 2006, whereas Nifty was up 300%. So somebody has an allocation to India at this point between 2004 and 2006 would have made far bigger return. If you all remember Sensex at 8,000 doom or boom by Mr. N.S. Fidai in 2005, this is exactly when Sensex broke out at 8,000 levels, and we saw 21,000 in just a matter of 1.5 years. So even if you see a 2007 to 2007 top, that 1 year move, we were up 50%, Dow Jones was up 25% only. So India did well in this time frame. So now let us look at the recent, the performances. Nifty versus DAX. Okay, we went down 17 to 18% from September 2024 until February end, whereas the DAX Germany has went up 23% in the same period, along with Italy and Spain being the top performance. That means one should have right allocation at right time based on the relative charts or relative outperformances can make far bigger returns with the right allocation. So that is the whole point here. Let us understand how the global markets are placed right now. Look at Japanese Nikkei. The highest point it made was 38,000 in 1990, and for the first time after 35 years it is knocking those highs once again, which is giving a big signal of a major trend change in Japanese market. Now let's move to the Japan market. What has happened in the last 6-7 years? Every time it gave a breakout from multi-top or a multi-month, it gave a 20-25% kind of moves. So first time it happened between 2018-20 breakout, and then 21 to 23 breakout, it moved another 20%. Again a new breakout in 24, moved 20-25%. And this was 3 weeks back. This was the setup. Now if you look at the current setup, it has given a clear-cut breakout. So can we expect the repeat of 20-25% move? It is absolutely possible. The index is knocking those 1919 highs. So based on the short discussion on the Japan index, the clearly outperformance is very much likely in this index. Let us look at Brazil, one of the Latin American market. It is also trying to give 2021 and 2025 breakout. It has done nothing in last 5 years. As I said, our core philosophy is to look at multi-year breakout where we can fetch 20-25% kind of growth. So this is one of the interesting market which is poised for a great upside. Look at Switzerland. So it gave a 2007 and 2018 breakout around 2019 and quickly gave a 37 kind of move. And then it consolidated between 2022 and till date. So any move that triggers about 30,000 and 13,200, this market is again set for another 20-25% kind of move. Look at Netherlands. It gave a breakout after 4 years, did 20-25% move, again setting up for a fresh breakout, a close above 945. We can expect a new move in the Netherlands market as well. Look at UK market. It was a breakout of 2018 and 2024. A retest came due to the Trump tariffs. Now setting up nicely. This was a chart which was 3 weeks old. Now currently if you see, it has given a clear-cut breakout which is giving a far bigger return on, and we can expect a 20-25% kind of rally even in the UK market. Now coming back to the UK, if you see, it is not a small breakout. It is a 2000 and 2023. So the trend has changed after 23 years. As I said, we look at multi-year breakouts, and this one is a multi-decade breakout. So all we believe is European pack is set up nicely for the next 20-25%. Sorry guys. Yeah, so this one is again a 23-year breakout. As I said, we are not looking at extreme short term rather than next 2 to 5 years. So when we look at any investments, we look at a large trend, because our investment is not typically for 1 week or 1 month. So basically we look at large trends and then we make those allocations based on the setup what we have right now. So look at one interesting setup again in France. So it is a 22 and 2000 breakout, again a 22-year breakout. So this is also setting up for a large 4-5 year kind of a bull market. This is recent data. You can see it is in the range 6,700 to 8,050. So new breakout in this index can see a fresh move in European market as well. So look at Europe 50. This is a top 50 stocks of Europe. This is a 2007 and 2023 breakout. So again, an 18-year highs. So not a small breakout. A recent Trump tariff did retest one of the trend line, which is connecting the, technically if you understand these things. So basically what it is hinting, the whole European pack along with Japan is looking at a far bigger upside in the next 3 to 5 years. All right, so this is the current trend. Yesterday it gave a fresh breakout from long to medium term trend as well. So we can see a continuation of the existing trend in the European 50 stocks. Look at Korea. We are coming back to Asia again. So this is a 1986 or 86, 88 chart, the trend line is coming around 4,100 roughly. So this market has also given a breakout. Okay. So recent data. So 2021, 2024 or 2025. So 4-year breakout again on the Korean market as well. Now look at Singapore market. This was lagging. So this has given 2008 to 2024 breakout. The fresh breakout has happened after 17 years again. So anything that is breaking out after multi-year. So what happens? There is large shift in the fundamentals, or the liquidity could be chasing these markets, and the large trend can remain on the upside for at least 3 to 5 years in those cases. That gives an edge for investors to stay invested confidently. So this is the latest price action. You can see a fresh breakout has come on the Singapore market as well. So the trend is likely to continue here as well. Now look at China, what China has done. Okay, people are talking a lot about China, the next big thing, blah, 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 etc., etc. Look what the price has done by yourself. Since 2007 top, nothing. There is no return. It is consolidating in a huge triangle, you can say. So it's been almost 18 years. There is no return at all. Of course, there is good valuation which came around 2300. There is a good bond, but if you see the large move, compare with European markets or other Asian markets, China literally did nothing. Okay. Also compare the Hang Seng. All right, see, it has also similar charts compared to the Chinese market. So no return since 2007. So all it can do is 27,000 or even 31,000. But there is no clear-cut bull market in China as well as Hang Seng. So we are not so optimistic on China or Hang Seng in these cases. Rather, we are bullish on Japan, we are bullish on Singapore or Korea or even Taiwan as well. So if I look at emerging market, including China, all right. So look at here, it started off in 2021 with a fresh breakout, but fizzled out because Chinese market started declining since then. So the index could not even cross the previous highs again at. Now, if you see emerging market ex China, so this is very interesting chart. This is a chart which is 3 weeks old. Now we will see the latest chart as well. So this was on the verge of 2021 and 25-year breakout. So will India shine? Will emerging markets come back now? So there are a lot of positive signals available looking at the current chart. Now look at here. This is the recent price action. It has given 2021 and 2024 almost a 4-year breakout, which means the emerging markets can start performing well against the developed markets as well. So will India do well in this case? We will see some examples as well in next slides. Now look at the emerging stock markets relative price performance in USD against the USD stock market. This has hit 50-year low if you compare with 1970, or if you compare with 1999 or 2003, we are almost there. So this ratio is declining since last 15 years. Now it is sitting around the long-term averages. So this is a signal for us to look at emerging markets, where India has a significant weight as well. So which means emerging markets against the US equities are available at very good valuations, and we see a great opportunity here in the market as well. So look at what happened in the last 5-6 years. You can put it as a rise and fall of India or China. Okay, so Chinese weight in the emerging market or MSCI emerging market index has gone down from 32% to 28% since 2018, whereas India's weight has gone up from 8% to 20% in the last 6 years. So India's weight has increased, which is a very strong signal that a lot of flow can come to India compared to China. So as we have seen in the previous charts, Chinese market is not in a bull market yet. So India has a great advantage having the next highest weightage compared to China, and also the India's weight is going up. We see a lot of flow coming to the Indian markets. Now, here, look at this emerging markets equity. Of course, I took these charts from the various sources. Let me admit that. So the one move started in 1988 was a super cycle. The second one we had in 2004 and 2008. We have seen how Nifty has performed, which was up 250%. So now we are back to 1999 or 2007, 2000 dot-com bubble levels. So this gives an added advantage for emerging markets based on the valuation against the US equities to put some allocation to India and the emerging market space as well. So now if you look at the emerging market relative valuation, which is at a consistent historical discount, now it is the cheapest since 2000 dot-com bubble crash. Okay, so that means the emerging market is going to come back in next 1 to 3 years at least. So India being the second highest weightage has a clear-cut advantage. So we are absolutely positive on India from emerging market point of view. Now, barring US market, this is global equities ex-US. We have seen Europe, we have seen Latin America, we have seen Asian markets. You see there is 15, 16, 20, 25 year kind of breakouts. Now, if you look at this chart, this global equities ex-US. Okay, this has also given 18-year breakout. This is a start of something new or something big. That's what we believe on the price action. Why we are not so super bullish on Dow Jones or US markets? So as we said, our approach is the biggest money is made when there is a big breakouts. Big breakouts happening after many years or a decade. So if you look at US, 3 weeks back, it was struggling compared to the European markets. Clearly, you see the European markets, the Asian markets were outperforming US. And 3 weeks back, this was the situation. And yesterday, as of yesterday, US market is back up and the 80 start a fresh uptrend. But as I say, since the big uptrend is in European markets, we expect the European markets. So of course, the Dow Jones will do well. Dow Jones might do 4-5% kind of growth. In those cases, European markets can do 20-25%. That means the outperformance can definitely come in the European Union. Look at S&P 500 weeks back, struggling to cross.
Shivaji, hi Shivaji, can you hear me?
Yeah.
Shivaji, your I think network is relatively weak. You may because your voice is cracking in between. It is going absolutely fine, but your picture has got stuck, and we can. Yeah, I think you.
Yeah, I'm back.
Perfect, Shivaji.
Sorry.
Absolutely. So in the meanwhile, I had just asked audience to write any questions, but you can carry on.
Yeah, sure. So basically, even if you look at Nasdaq, which has crossed recent high. Yeah. So even US market started performing well. Look at the US small cap as well. A couple of weeks back, it has given a breakout, and now the momentum has started even in this index as well. So if you look at the German market, this is one of the first market to hit 80 edge, followed by Italy and Spain. The reason is these markets are relatively much stronger compared to the US. If you see US, they have hit a new high recently. So the money was allocated to the European markets in the last couple of months would have yielded far bigger returns compared to US. So let's look at what has happened since January 2025. European stocks are up 13%, whereas S&P 500 is up 1% until March 2025, and this ratio will also change, which is in favor of European stocks. So the relatively European stocks have done well compared to the US. If you look at country wise, Germany is up 21%, Italy is up 19%, France is up 17%, UK up 12%, whereas US is flat to negative if you look at 2025 returns. So if you look at the whole European pack with 600, so this has given a 25-30 year breakout. That means you take a Czech Republic, you take Prague, you take Norway, you take any market, they are giving a multi-decade returns, breakouts. So this gives an opportunity for global investors to look at Europe seriously. People are coming up with doom in the European Union, but look at what stock market is doing. So it's very important to look at what market is doing rather than looking at the noise or the news. So let us understand India. Now, as we discussed, Manocha is very high allocation, especially the India compared to China. So how India is placed right now. So of course, in India here. So let me discuss the Indian Nifty. This is a couple of weeks back. If you see, there was a breakout around 24,200. Then we started consolidating from last 40-45 days. So there is a gap here around 25,650 and 750. That is exactly what we have tested now. Okay, now we are coming to the 2,500. If you see the context, we are which is a possibility of 400. There is a downside support around 2,300, 800. So largely India is also well placed on a technical chart as well. Now you see what has happened since 2012 and 2025. If you pick the last 13 years, the top 4 sectors have given you an average return of 15% to an extent of 60%. All right. So when you make an allocation, if you make your biggest allocation to top 4 sectors, there is a high probability to make a far better return. So if you look at 2025, we have been talking about private banks, infra like Bharti, for example, right? The PSU banks and the commodities. You look at the first top 4 sectors, they have done well. And every year you see there is a different sector performing. That's mean leaders rotate. You need to change your strategy. In order to make returns efficiently. As I said, we always believe in selection, allocation, and rotation. Since the leaders are rotating every year, so every year you don't have the same leader, right? So leaders rotate. That's the important signal. So the 25 has come up with a new leader. So you need to have allocation as a fund manager to make a far better return for our investors. So this is the current situation as of 2025. Now look at some of the currencies. Euro USD has given an 18-year breakout. That is one of the reason why Europe has started doing well against the United States. So I did came up with a tweet around January 2025 when it was trading at 1.02, expecting 1.15. So currently trading at 1.17. So there is a clear-cut 15% upside in this currency pair in the last 6 months. And the same duration, even the European markets have done well. All right. Look at Great Britain pound and the USD. That has also given an 18-year breakout. So clearly the European Union is performing really well against the USD, and even the European markets you see has done well against the US equity. This is one of the reasons. So you look at the another currencies compared with the Middle East currencies like the AED, which is pegged to USD favor, this has also given a 17-year breakout. That means the European markets as a whole pack in the next couple of years can be a very interesting spot compared to the US. All right. So does it mean end of the road for DXY or the dollar index? Of course, we believe in the long run, the dollar index can come down significantly, but currently the 96 remains a very strong support because of 2011 and 2025 trend line. But looking at GBP as well as Euro against the USD getting stronger, so we believe dollar can weaken going forward. All right. So some of the commodities we will look at. So I did come up with the platinum, which was a 17-year breakout around $1,100. So it did $1,435 in a span of 30 days. So this commodity is up 30%, while silver is up 10-12% in the same period, whereas gold is flat. That means in order to optimize, as I said, we always look at as a strategy in year or a multi-decade breakout. So hence platinum was preferred over silver and gold. And this is what exactly the platinum has done. Look at gold, did nothing. So it is in sideways. There is no new trend at all. So it can consolidate in this range as long as trading between 34.50 and 32.80. All right. Of silver has given a first time close around $36, could do 38 or $40, but the platinum stand out a leader here. As I said, leaders rotate. In 24, silver was the leader and gold was the ultimate leader, to be precise. They did 35-40% kind of move, whereas in 2025, you see within the same commodity space, leader changed from silver gold to platinum. Now, what copper is doing right now? An amazing 19-year breakout. With the recent Trump tariffs on copper by 50%, it has given a massive breakout above $5.45. We could see potentially $7.5 and $8 in next couple of months. So this has completely changed the copper chart in terms of market dynamics, in terms of technical chart as well. So we believe copper can outperform going forward in the commodity space. Can we really see on a ratio chart as well? Look at copper versus gold. So showing a great turnaround. So means copper has better chance to perform the gold. That's why we are not bullish on gold. We are not that great bullish on silver. Rather, we are bullish on copper and platinum in the last case. So I did came up with a lot of tweets. You can go and check in January as well as in April when Trump came up with tariffs. We were extremely bullish on European markets. One of the reason is their currency broke out after 18 years. That was a big signal for us as well. Now, what are our priorities with respect to global markets? First, European markets stand out as a leader. They have given 17-25-year breakout, huge opportunity for us. In the emerging market, India being the top bet due to the EEM weight, which is going up significantly in the last 6 years compared to China. Metals, we are looking at platinum, copper as a leader. Then comes silver, we are avoiding gold. Currency, we are absolutely bullish on Euro USD and GBP USD. Of course, there are many currencies which are doing well, but these are the major currencies in the world which we are extremely bullish on. We are negative on the USD or DXY over the long term. This has been our strategy going forward. Now, if you are looking at investing in the global funds, because you see a lot of opportunities in Europe, in Asia, in Latin America, there are many global funds available. Of course, we will come up with our own global fund in near future, but these are the available closed and open-ended funds in India. Of course, these are not endorsement. I've just taken out this list from the internet for your understanding. You can check with your financial analyst. So that should be taken care. So now, of course, there are tax complications in India. You need to pay taxes, all that. If you are looking at saving tax and pay 0% in global investment, that's like no tax on the capital gains. Of course, there was a big news recent times. Habibi, come to Dubai, become an NRI. So Dubai gives you 0% capital gain tax benefit on global investments. And if you're an NRI, the gift city gives you an advantage to make 0% tax returns in Indian markets as well. So With this, I end my presentation. I leave it to Kamalji to start the question and answers.
Sure, Shivaji, we will stop the presentation. Perfect. First of all, apologies to everyone, for somewhat of audio and video being weak. But I hope, everybody was able to kind of make out, because I found the presentation very interesting and have a lot of questions in my mind. So we'll start, with the first question. Shivaji, I first want to understand basic aspect that, the fund that you currently are raising money for, that long short fund, right? So what is the context of that long short fund? Because I am sure audience wants to understand whether that fund is investing in various countries, various economies, various stock markets that you mentioned, or it is just exposed to India. And if it is just exposed to India, then what is the context of discussing, all these other stock markets? While it is very interesting to know, the viewpoint that you mentioned about Japan versus China versus Singapore, Korea, US, it was like quite insightful, and I'll cover that in subsequent questions. But foremost, the basic question.
Yeah, see, when anybody is investing in India, the biggest fear is the global markets. So what can happen in US? What Trump can do? What can happen in Europe? Because we see a lot of negativity or negative news coming out of Europe. Europe is going into recession, blah blah blah, and there is a China case as well. So what happens when we approach the market or when we try to invest in India? So we basically look at the global aspects as well, and that gives you the confidence. If everything is in place, in order, and there is a lot of positivity globally, then definitely the investment in India gives you that confidence. So we bring that confidence on the table by looking at global markets. That is the core principle or the main idea behind that. Our fund as of now is more of India focus fund. So we are investing only in the Indian markets. As I said, we will be coming up with a global fund in near future
Sure. So, Shivaji, can you hear me?
markets as well.
So, yeah, it's perfect. So, I would
As
suggest
I said,
maybe you can switch off your
we
camera,
are
switch off
investing
your
in
video.
India, but we are looking at global markets to get that confidence for the next. Am I audible?
Yes, yes, you're audible. Absolutely. Please carry on.
Yeah.
Shivaji, you're audible.
Yeah. So that was my answer to your previous question. I'm ready for the next question.
Sure, sure. So, you also mentioned about gold, silver, copper. What is the kind of, I would say,
Yeah.
target universe of asset classes where your fund is exposed to? Is it India focused equity fund or a multi asset fund?
Yeah, we are a multi-asset fund in India as well. We are allowed to invest in commodities. We are allowed to invest in currencies as well. So we will have a bit of exposure to commodities with respect to gold, silver, or even copper. Of course, platinum is not available in India. So we do have some bit of allocation as well to these commodities.
Sure. What are the kind of, I would say contours around which you operate in this fund in terms of how much you can leverage, how much you can invest in commodities, how much you can invest in equities? Can you please explain all that? Because now this is becoming very interesting conversation, because a multi-asset long short fund
Yeah.
is something, which is interesting. And before I ask further questions, kindly explain, what are the kind of contours, and in terms of percentage allocations that your fund would do, or if there is any
Yeah.
yardsticks or any I would say upper limit or lower limit in terms of allocations.
Okay. So with respect to the exposure, the SEBI allows 2x maximum allocation. with respect to the your AUM. So if you have 100 crore, you're allowed to invest maximum 200 crore if you're taking a leverage. All right. So in a particular segment, that means a stock, the SEBI allows a 10% allocation. There is no limit on the sector allocation. Of course, we can do 20-25% allocation. As I said, we invest largely in 5 to 7 sectors. So we might have 20% or a 25% allocation to top 3 or top 2 sectors. Okay. So with respect to commodities, we will definitely reserve a 10 to 15% of our AUM. If in case there is a great opportunity, as we discussed, if there is a multi-year, decade breakouts, if we see a clear-cut outperformance, definitely we would love to allocate more, but we would keep it 10 to 15% maximum to the commodities. Rest will be allocated to the equities.
Sure, Shivaji. With regards to now equities, like you mentioned, your view on various other economies and stock markets. Let's focus on India because the audience out here is kind of wanting to understand your view on various sectors, and kind of you can obviously start to give based on your technical analysis and fundamental analysis. What are the top 3 sectors that your fund is having exposure to, and why that exposure is there to these sectors?
Okay, so if you look at, I came up with a lot of interviews since April 7. So we were extremely positive on the NBFC and the financial spaces. Okay, if you look at the recent top performers, the financials or the private banks, stand out clear leaders. So we have exposure to financials. We like the insurance space that is buzzing after a long time. We like PSU banks as well. We do like some of the selective pharma space. We completely avoid metals and IT sector as of now because of the lot of news coming out, and the results are coming as well. So pretty much very high volatile sector. So if I say top 2-3 sectors, I would put NBFC, insurance, and the infra space.
Sure. And what number of stocks and what allocation between large, mid, and small?
So as I said, we completely avoid a majority of the small caps. So right now we have small to mid caps only are 90% of the allocation in large caps, and 10% is in mid caps with respect to equity. And with respect to allocation, we can have maximum 10%, as I said. So that would be our top 4 or top 5 bets only.
Sure. See, the thing is, at present, I see different types of fund managers who are like of the view that at present market environment is not giving too many opportunities to deploy the corpus because you have started a new fund and your corpus is less. I'm sure you are able to find meaningful opportunities for the corpus that you're deploying, and that is one advantage which for any investor who would like to look at your fund is because your fund obviously is a boutique nature and the AUMs are currently lower. But for those fund managers who are like bigger fund managers managing maybe 1,000 crore or a 2,000 crore fund, how do you see them? I want to know an independent view because you see market from opportunity standpoint, and you also see industry, from various competitors that are there. And from investors, they have to choose you versus the other fund managers. Obviously, other fund managers show track record, and you are building your track record. But at this point of time, many of the fund managers sitting on cash. That is what is kind of keeping investors also confused, whether they should actually go with other fund managers who are saying that they don't have much opportunities to invest in, and markets are in the perplexed and complex scenario because obviously things are unfolding and we still have a lot of macro uncertainty, which is around the market. Though we know Indian equity market has shown signs of breakout, which you also covered. But if you could cover this aspect in detail, that will be good.
Okay. So if you look at 2018, a lot of funds were, with a lot of cash. Okay. I don't want to sound negative on any fund manager in person or in particular. Rather, if I sit on the sidelines and observe, they were lucky due to the 2020 crash. All right. And they could deploy around, March, April 2020. I think the same mistake is being made even now, thinking that having cash is a good idea because they didn't invest at 22,000. Now it is at 25,000. They think it is expensive. See what happens after a big bull run, and when you correct 15, 17%, you tend to go sideways. And in this period, new leaders emerge. As you can see in the last slides we discussed, every year the leadership has changed. Even in 2025, the leadership has changed. So there are lot many opportunities, lot many sectors which are giving a big trend change signal for next 1-3 years point of view. So I think we would even if I have 1,000 crores, I would fall short of money to invest in those sectors. I would not be sitting on cash right now, to be very honest, because you see a lot of opportunities. Like you look at insurance space, you look at private banks, especially the smaller private banks, look at some of the large PSU banks, and look at the railway sector that is turning around. Defense came out really strong, and look at the pharma selective space. All right, they started moving really strongly, and metal is also poised for a much larger breakout. Look at infra space, especially the Reliance and the Bharti, for example. If you look at Indus Tower, for example, I'm not advocating any buy or sell here, rather than I'm just pointing at stocks. So there are various stocks emerging as clear-cut leaders. Okay, and some of the real estate stocks are also coming and giving a large breakouts, as we discussed in our PPT. It could be a multi-month or a top breakouts. So we clearly see a lot of opportunities. I don't see there are very big negatives in the world right now. That's the reason why I showed the entire world picture to give that confidence to investors that look, India is well placed with respect to emerging market. World is placed really well. Look at US, look at Europe. They are the bigger market, they are the developed markets. There is no problem at all. Why would be concerned so much and hold very high cash? And that would be suicidal, in my opinion, if you are holding too much cash. And maybe you can try to chase at a very higher level. Of course, at index level, we are not in a new bull market yet. We are yet to cross the previous high. Look at some of the sectors. They have crossed equivalent of 26,200 highs. Look at Bank Nifty, clear cut leader. Look at Nifty Finance. Look at the metal index. As I said, even the pharma is coming into play. Infra, new highs. So look at oil and gas space, especially the OMC markets. That is signaling something very big. So I don't think one should be holding a cash right now. You have to be very selective. As I said, look, your allocation should not be too diversified. Rather, it should go into a top 4 or top 5. Your 80% of your allocation should be in the top 5 bets. That's when you can create better alpha. And of course, on the downside, if Nifty corrects, let's say another 5-6% from here, so you could lose 7-8%. All right. Or if you are in a better sector, you could be less impacted. So all I would see here is a 3-4% kind of downside with a big upside in next to 12 months. So I would not be in cash right now. Rather than I would be investing more in upcoming sectors.
Sure, Shivaji, this is a very, I would say, bold perspective. And for audience out here, obviously, all these webinars that we do every Friday are more for learning and for understanding different perspectives, and really respect your perspective. I also tend to an extent, agree with your perspective. So moving on to this conversation, it's becoming very interesting. You mentioned that, yes, every bull run has different leaders, and this bull run has leaders that you mentioned, like foremost as financials, and then you covered other sectors also, which is like infrastructure. But if you could kind of give maybe a more detailed answer to this, that how do you see new sector leadership evolving, like within financials, you mentioned insurance and others. If you could just spend some more time, because given your background and given your optimistic lens of seeing on weekly basis, if not daily basis, that how do you see leadership emerging, is something which is very interesting aspect that I would like to understand from you.
Yeah, sure. So in the financial, I'll mix both the NBFCs and insurance here. Okay. If you look at, for example, L&T Finance, you look at the Bajaj twins. So they are on the long-term scale giving a far better, setup compared to other financials. Okay. So these pockets can surprise us in next couple of years. Coming back to the insurance, look at HDFC Life or even the AMC sector like HDFC AMC or the ICICI General Insurance. You look at SBI Life, even the SBI cards. So these pockets are pretty much interesting in next 1 to 2 years. As we clearly see, the financial as a whole pack is doing really well, and some of the smaller private banks can also surprise. Maybe you can take Aditya Birla Capital, for example, to look at, or you look at the Federal Bank from the smaller private bank space. So they offer a great, risk reward, and potentially they can give you a far better yield going forward. And if I take the insurance pack, as I said, fundamentally the things are also changing. Maybe you can debate about that, but we believe going forward the smaller private banks plus the insurance along with the NBFC space can do really well. I hope I answered. If I missed something, please feel free.
No, right, absolutely. And then moving on to say second sector beyond financials, which is the second sector that you see, as a new leader emerging.
Yeah, I mean, I can pick as a PSU bank space. Of course, it is again from the financial, but it is a public sector. I would like to bifurcate that way. Look at the results and look at the setup that is forming technically, looking exciting on the chart. Then I would look at railways. Okay, the railways has come out, as I discussed, we look at a bottom reversal. Okay, after a big fall, the railways was a big theme in 22, 23 and corrected a lot. Now you see there is a good accumulation happening in the railway space as well. So defense will remain a good bet, but with the recent uptrend, I think I this moment rather look at railways as a great opportunity as a second contender.
Sure,
After financials.
Sure. With regards to your process of investing through your fund, what I would say weightage you could give to technical analysis versus say fundamental analysis. And when you buy a company, obviously you before that you, based on your background, would look at the attractiveness of that sector being breaking out, and then obviously that business. But beyond that, what are the other things that you will look at before adding that in your portfolio?
So we definitely look at fundamentals of every sector and every company. As I said, our main priority or the filtering out the any sector would be based on the liquidity of that particular sector. Plus the fundamentals needs to be pretty good. And as I said, we time it based on the technicals, but we look at fundamentally for each and every sector, and we try to figure out whether they meet certain criteria as per our checklist, in our investment committee discussions. So if they meet those criteria, we will definitely, time that sector using technicals. We would definitely try to use technical as a main aspect here. The reason being, as I said, is the timing, getting into the sectors. Fundamentally things can be really good. Fundamentally stocks can be really good, but you have seen many cases stocks may not perform even though fundamentally sector or stock is good. It always depends on when the smart money gets interested in that particular sector. That can be visible using technicals with the price volume actions. So we do this way: we shortlist the sectors and stocks with the technicals, then we back it up with fundamentals, and the entry and the exit is again decided on the technicals. So that's how we strategize our investments.
Sure, Shivaji. Very, very, interesting. Moving on to the final set of questions. You are an optimistic fund manager.
Yeah.
The market environment you have covered country by country, economy by economy, and you kind of are trying to demonstrate that it's the time not to sit on cash. It will be suicidal to sit on cash, is what you mentioned. And at the same time, obviously, in
Yeah.
Indian context, also you see new leadership emerging, and you pick
Yeah.
fundamentally good businesses, good sectors, but at a right time, and you have that lens to pick out, which is
Yes.
new sector or stock leadership emerging. All these points are quite clear and kind of now sinking in really well. But this raises one, I would say, question, and that is what I'm going to ask you: that if all these things are in tandem, why do you not have a long only fund? Why a long short fund? What makes you have shorts in your
Yeah.
portfolio?
Great, great. So if you look at the long short funds in India, in the AF category, there are roughly 133, of which 95 are long only funds, and roughly 35 or maybe a little more on the long short side. So we are a minority within the AF category. So if you look at the recent fall, what has happened? The 70%, or you can say 80% of the funds or long only, they are down significantly. All right, there are long only funds which have done well, I don't deny that. So with the long short, what happens, it gives you an edge to go short naked or to have long short. So in order to contain the downside in a falling market, see, how do you separate better funds? It is in the bad cycle, right? So when you have the flexibility, of course I want to have all the weapons in my archery so that I can use any weapon anytime. So in a downtrend market or in a bad phases, I want to contain my downside. If you are down 5-6% when others are down 15-20%, then the cycle turns or the tide changes. So then you can come back pretty quickly in the game, and you could actually give far better to your investors. So going naked short is a separate thing. Again, it's a different skill as well. So if we get, let's say, a 2022 situation or a 2016 situation or even 2008, we never know, it might happen in 28 or 2030. Whenever it happens, I should be in a position to make those changes in my strategy. So I want to have that flexibility. If I'm a long only fund, either I have to deleverage and sit on cash. Now how much you can deleverage, which we don't know. At least I have the flexibility that I can be 0% long and go 100% short also. This gives me an edge. So I can be a mix of both, or I can be completely short in order to limit my downside, in order to come back in the game when the tide changes. I want to have this option. So whether to use it or not is a secondary thing, but based on the market dynamics and situations, I would keep those options pretty open. And that's why we would be in the long short space rather than long only fund. Of course, as of now, the situation is pretty good. As I said, if you come across situations like 16, 18 or 2008, then I would love to have that flexibility. So rather than looking for that flexibility in those times, I would like to have them right now, and I can use whenever needed.
Sure. So we can call your fund as a long only fund with the option to short to the extent of 100% of the fund, and hence obviously it becomes a long short fund. Is this what you're trying to convey?
In the current situation, yes. Plus, for example, if the market, let's say another 3-4% goes to new highs, and let's say I want to hedge my position, okay, I can be mix of long short. Okay, I would like some sectors, as I discussed. I would not like some sectors. I would go short on those names. So in current situation, as I said, what happens in a consolidation, you have some sectors doing well, some sectors doing bad as well. So in those cases, in order to balance out your performances, I would love to have shorts as well. So that's why I would like to be pretty much open. I would not be calling myself a long only, rather than it is mostly based on the situation. So currently the situation gives you more edge on the long. Tomorrow, after a couple of weeks, if things change, I could be long short.
Understood. Why did I ask this question? Because I was trying to understand it more from investor point of view, and I'm sure investors would have this question in their mind. And then last question that comes to my mind is that while there are a lot of other long only funds, while other fund managers are also equally smart, when they also see valuations kind of at a point from where corrections can come, or any black swan event, which obviously, in my view, nobody can predict. But if there is some smart fund manager who can predict that,
Yeah.
isn't that in a long only fund one can use derivatives to ultimately hedge? Why is the need to have a long short fund? Why not long only fund with a, because in AIF structure, in my view, you can do hedging by using derivatives also.
Yeah, yeah. See, what if you come across a situation like 2008? You can't hold longs. You can be completely short. You need to have only the long short in those cases. So what if you come across 2016, right? So you never know when that situation can come. So you need to be ready for those situations, and then you have to have particular strategy that should be only naked short in those cases. That's why I would love to have the both options.
Sure. What are your views on commodities right now? We have seen last 1 year, like gold, silver, these two precious metals have done really well, and there are like many fund managers who have missed this. You
Yeah.
said that you have like built positions and made money, but presently, we know both of these precious metals are kind of at unbelievable levels. But what are your views, both I would say from technical point of view foremost, and then if you have any fundamental aspects also to be covered.
Yeah, with respect to commodities, gold has done significantly well in 2024. Now you can see it is going sideways. I'm not that great. I mean, bullish on gold right now based on the current setup as well. It could consolidate. Maybe you can see 5-6% of upside in near future also. But when I talk about outperformance, it should be in terms of 25-30%. So clearly the copper stands out as a leader right now. The silver has given a 35% move in the last year. Currently, the resistance is somewhere around 39.5 to $40, which is again 5-6%, which is not great. The platinum gave a 30% move in 1 month. So I would rather look at the next leader, which is copper. So I've not looked at zinc and lead, to be honest. Otherwise, I would have commented. But copper clearly stands out as a leader in this space, and I would be more interested in that. And also, the ratio chart of copper against the gold is also turning around, and and silver as well. So copper is likely to outperform both gold and silver in this case. So in that case, my higher allocation could be in copper than in gold and silver. Of course, people think gold and silver are precious metals. You should have some allocation. That's absolutely fine. But if you look at the outperformance or relative strength, then copper clearly stand out as a leader in current juncture.
Sure, Shivaji. Just to give disclaimer for anyone who is like right now logged in, or people who will watch this video again, this is just a discussion for education purposes, not to be construed as any advice. If you want to do any investment on your own in any of these asset classes, sectors, or stocks, kindly be careful and kindly take very well informed decision, or kind of refer your advisor. Do not construe any of the discussions done in this webinar as any advice. It is just for education purpose. Lastly, this is the last question, Shivaji, with regards to your fund. In the long short category, generally, what happens that those returns from the point of view of what fund managers aim to do are generally, I would say, fine, because we are living in an economy which is doing really well, and somehow fund managers are able to find out some good sector or some good stock. But the taxation and expenses, when they come together, and they put a very I would say a bad pressure on the overall returns. So from the point of view of net of taxes and net of expenses, how much return do you think this fund can actually generate? I'm not wanting you to talk about any assurances or any returns particularly, but I'm wanting to understand that what
Yeah.
percentage of the return will go in taxes or will go in expenses, because that will give investor a very fair and right information which he has a right to understand before he kind of makes up his mind to consider this fund.
Yeah. As I said, we are looking at a time frame of 3 to 12 months. So we are coming between short-term capital gain rather than long-term capital gain. So 20% on the short term, and when we mix it with the derivatives with the long short, then you're also covering the highest tax bracket of around 38%. So we will be mix of both. That will be the tax burden. To be clear on the tax part. Now coming to the expenses, we are at 2% year on year, which is in line with the industry standard. In terms of returns, what we are looking at now, look at the return of the Nifty in the last 10 years is 14% roughly, and 70% of the funds do not beat. And when we started the Gift City as well, we were looking at 25% to 30% gross because of the tax advantage. We did 46% net in the last 4 months. So in the domestic, we are looking at 22 to 25% net post tax, post expenses. That is our target for ourselves. I mean, I'm not assuring this return as a disclaimer. So pretty much, we would like to beat the Nifty first with the net return. Also, we want to stand out as the top performing funds by delivering 22 to 25% net return. I'm not talking about gross return here. Rather, we are focusing at 22 to 25% return post tax, post expenses. This is the goal we have at a company level. Of course, these are not assurances for investors.
Sure. Thank you so much, Shivaji, for your time. We'll again connect with you and do webinar for the audience. But it was really interesting and I would say intuitive to have this conversation. Thank you everyone for joining. I again give this disclaimer to anyone who will watch this webinar again, that any return, any sector, any view, any stock, anything that we have discussed in this entire webinar is more for education purpose. It is the view of the speaker, who is a SEBI regulated fund manager, not to be construed as any kind of advice. Thank you everyone for logging in today, and thank you, Shivaji, and all the best for your future. Thank you so much. We'll be in touch, and I'll again have a conversation with you to have a subsequent webinar, maybe depending upon the response that we get. Thank you once again.
Thank you so much. And if I missed any audience question, they can always come back to my Twitter handle, ask your questions. I would love to answer. Okay. Thank you. Thank you so much.